In this video, we talk about a first-year RMD tax trap that looks like an IRS benefit, like they're doing you a favor, but in reality, they're setting you up for a much bigger tax bill. Coming up next on Holy Schmidt.
Holy Schmidt!
There's a decision that the IRS lets you make, and for a lot of people, it looks really appealing. And when they choose that option, it costs them $4,000, $5,000, $6,000, $7,000, $8,000 in extra tax. It's not a scam. It's not a loophole. It's a standard option presented right on the IRS website. And this has gotten a lot of attention from the financial media lately, and for good reason. One of the headlines I came across calls it an RMD tax trap, and that's a good name for it. Now, if you're over 65, you probably know what an RMD is. But most people don't know that your first year you have an option on your RMD. So today I'm going to show you exactly what that option is, how it affects your taxes potentially, how it could affect your Medicare Part B premium, and I'm going to use two characters familiar to you on this channel, Calvin and Marvin Miller, identical twins. If you were born between 1951 and 1959 and you have an IRA, a 401k, or a 403b, the IRS requires you to start taking distributions from those vehicles by the time you turn age 73. That's the law. You can't leave it in there forever. The IRS wants its tax on those distributions, and some people keep pushing it off and pushing it off. Well, the IRS sets a threshold, and that threshold, if you're born between those years, is age 73. And a quick note for those born in 1960 or later, the threshold is age 75, but the same rules apply and the same trap exists. And here's the trap, and frankly, it looks innocuous enough. Your first year only, you can take your first required minimum distribution before December 31st, or you can take it as late as April 1st of the next year. Now, for a lot of people, this sounds like a gift. More time for the market to grow. Maybe the opportunity to spread things out a little bit more. There are a lot of reasons why people might want to do this. But what the IRS doesn't say, and what is not obvious until you see it in the rearview mirror, is that this option creates, for a lot of people, a very expensive tax bill. Now, here's the part that the IRS doesn't talk about. If you delay and you take your first RMD before April 1st of the following year, you still need to take your second RMD that same year. So you're taking two RMDs in 1 year. The IRS uses something called a uniform lifetime table to determine how much you need to take out every year. That means your first year distribution at age 73 is your account balance at year end, December 31st, divided by 26.5 or 3.77% of the balance. Now, what happens if you take that late and you have to take two payments in the following year? Let's use my favorite example, Callum and Marvin Miller. In this case, they're both age 73. They both waited until age 67 to take their Social Security. They both get about $30,000 per year from Social Security, and they both have $1 million in their IRA. Callum, the older brother by a few minutes, is the cautious one, and he takes his distribution on December 15th of the year that he turned 73. Marvin reads the IRS website, and he thinks, why should I pay tax this year when I can push it off until next year? In the year that Callum turns 73, he takes his Social Security payment and he takes his RMD, which is $37,700. But the next year, Marvin has to take his RMD from the previous year, that's $37,700, plus the RMD from the current year. Together, that's $75,000. And he has Social Security. And let's assume that both Marvin and Callum have other income, maybe dividends, maybe interest, that sort of thing. So there's a bit more in there, but these numbers are round enough so that you can see where this is going. All of this is stacked up, and everything bad that happens downstream from there is a result of him making the decision to delay taking the first year RMD until he was age 74, or at least his 74th year, before April 1st. Let me show you what happens to $75,000 of stacked RMDs for someone who's single. In 2025, for a single filer, the 12% tax bracket runs from $11,925 up to $48,475 of taxable income. The 22% bracket starts right above that and runs up to $103,350. Now, Callum took his RMD on schedule, And because of this, he was solidly in the 12% tax bracket. Now, Marvin, in his stacked up year, pays double that. And more of his Social Security payment becomes taxable. In fact, he blows right through the 12% tax bracket, and a significant portion of his income is taxed at 22%. Plus, he's moved into the 85% Social Security taxable income bracket. On just the tax bracket jump alone, Marvin pays $4,000 or $5,000 more in federal income tax than Callum did on the RMDs over the 2-year period. The fact is, by waiting, Marvin didn't avoid paying income tax. He still has to pay income tax on that money. He just pushed it into the following year and elevated his tax bracket. And the elevation of taxes isn't even the worst thing that happened to Marvin. He also has to consider a higher Medicare Part B premium called a Medicare Surcharge, or IRMAA, in 2 years. Speaking of Medicare, gang, Medicare can be overwhelming. It can be confusing. Ask anyone who's age 65 or older, and they will tell you that that is true. On this channel, we have 3 affiliate relationships. One is our trusted Medicare partner, Chapter. Chapter is the only national Medicare advisor that looks at and recommends every plan. They're totally free to you. They save their clients an average of $1,100 per year, and it takes about 20 minutes of your time. They're really easy to work with. So if this is of interest to you, give them a call at 440-703-1224 to see if they can help. Okay, back to Marvin's growing list of consequences. Now, we've talked about the increase in tax bracket. Now let's talk about Medicare. If you're on Medicare and at age 73, you would be on Medicare. The vast majority of people would be anyway. There is a Medicare consequence to having higher taxable income. It's called IRMAA, IRMAA. It's a surcharge on your Medicare Part B premium and your Medicare Part D premium, and the surcharge is based on your income. So the higher your income, the more likely you're going to pay the surcharge, and the higher your income, the higher your surcharge goes. And it has 2 features that are especially dangerous for someone in Marvin's situation. The first is that it behaves like a cliff if you cross the threshold. If you're single in 2026 and your income in 2024 was over $109,000, then you could and very likely will pay a Medicare Part B premium and a Medicare Part D premium. If you're married, the number is $218,000. If you go $1 over, the surcharge isn't $1, it's quite a bit more than that. The second is that a lot of people don't even know it's coming because it's based on your income from 2 years earlier. People start the new year with a Medicare Part B premium, and all of a sudden it goes way up, and they have no idea why. Now, in Marvin's case, he's single. He has $75,000 of RMDs, $30,000 of Social Security. We don't know what he has in other income. He may or may not cross that $109,000 threshold. But let's change one variable. Instead of having $1 million in his IRA, he has $1.3 million. Or let's assume that he's married. His wife has a very similar situation, but she also has a small pension. Now you're over the threshold. And once you're over the threshold by even $1, your Part B and your Part D premium together go up by about $95. That's $1,148 per year if you're single, and $2,297 a year if you're married. So Callum, who took his required minimum distribution on time, never even came close to crossing that threshold. Marvin, he wasn't so lucky. And to be really clear on this, the IRS and the CMS, the Centers for Medicare and Medicaid Services, they talk. And this happens automatically. You don't need to let them know that you earned a certain amount of money. The CMS already knows. The increase happens automatically. Now, I want to be fair here because there is a specific situation where this is actually an advantage. And that's when you have big income in the year that you turn 73, and it's going to be lower in the year you are 74. Maybe you sold your business at age 73. Maybe you had a one-time lottery win. I don't know. Something happened at age 73. And so by pushing your RMD to age 74, you actually are reducing the tax bracket that you're paying taxes into. And then there might be some specific charitable planning considerations and the interplay between that and qualified charitable distributions. In this situation, the timing of your RMD matters. In 2026, by the way, the QCD limit is $111,000. who knows what it's going to be in the years ahead. What is important to note here is that the QCDs do count towards an RMD, and they don't show up in your taxable income or in your IRMAA surcharges. But for the vast majority of people, these are very narrow examples, and for most of you, the simple choice is usually the best choice. Take your first RMD distribution by December 31st, not by April 1st, unless you have a very clear, specific reason for delaying it until the following year. Now let's say that it's too late. You already waited until April 1st. The structural situation is already set up. You can't change that, but there are a few things you can do to soften the blow. The first is what we just talked about, qualified charitable distributions. Any QCD that you take in the year that you're 74 can reduce your taxable income in that year. The way it does that is that it reduces or eliminates your RMD requirement for the new year. Second, talk to your CPA about your 2026 withholdings so that you don't face underpayment penalties. Third, consider whether you want to accelerate or defer any other realizations from your IRA or other taxable income, like, for example, a Roth conversion. And one additional point here, and this goes not just for the topic we're talking about here, but for anything related to the IRS. Just because they give you an option doesn't mean that it's a good option. You always need to consider not just what that option does for you in the moment, but what it does for you this year and in the following years. For a lot of people who exercise this option, it increases their tax in 3 different areas: federal income tax, Medicare surcharges, and also an increase in the Social Security taxation. One decision, 3 different consequences, and most people only see the benefit, the day one benefit, by delaying. They don't see what happens in the following year. So if you're turning 73 this year, mark your calendar for December 31st, 2026, not April 1st, 2027. If you want to know what your RMD is going to be, look at your year-end balance and divide it by 26.5. That is your required minimum distribution. Also, set up federal withholdings directly from your distribution. Most custodians will allow you to do this. In fact, you can do it in about 90 seconds. Next, if your income, if you're single, is anywhere near $109,000 or more, or $218,000 or more if you're married, understand this very clearly because this is a trigger point for IRMAA surcharges. And while you're doing this, this is a very good time to look at your Medicare premiums and make sure that you're not overpaying for your Medicare. Even retirees who don't reach the $109,000 level or the $218,000 level often will overpay for Medicare Part D or their supplemental plans. If you like this video, check out that video. Most retirees don't know that this Roth conversion window closes in 2028. Also, don't forget to give Chapter a call at 440-703-1224 if you have any questions about Medicare. This is Jeff Schmidt, and I will see you in that video right there.